Every empire guarantees that its own money is safe. Governments claim that the assurances they give will never come to an end. But history always proves them wrong. From Rome to Lebanon, from the Confederacy to revolutionary France, people have seen their entire savings lose value overnight, their salaries become meaningless, and everything they own taken away by the systems they trusted and believed in. Collapse is constant. Collapse exists everywhere within the process. The real thing that must be understood here is not whether financial systems will collapse. It is how you protect yourself when collapse happens. We look at our bank accounts and the diversity of our investments and assume they stand on solid ground. But money is not a foundation. Money, in its truest sense, is trust. And the trust we believe in so deeply can disappear overnight. For this reason, history is as cruel as it is instructive. Every collapse provides information, warnings, and lessons about what truly protects wealth and what turns to dust. And if you pay close attention, you encounter an uncomfortable truth when collapse happens. The ones who survive are not those who trusted the system the most, but those who viewed it with the most skepticism. Let us consider Byzantium. It is especially known as the Eastern Roman Empire that remained standing long after Western Rome fell. At the center of its economy was a gold coin called the solidus. It was so trusted that traders operating from Europe to the Middle East and even Asia accepted it without question. For centuries, it stood at a level that could be considered the global reserve currency of its world. You would think they had learned from Rome's silver denarius disaster. The emperors had debased it so heavily that it had effectively turned into tin coated with silver. Was that the end? No. Centuries later, Byzantium made the same mistake again, this time with gold. First, they reduced its purity. Then they thinned it and added cheaper alloys. At first, no one noticed. But eventually, trust came to an end. The coin that held a crucial place in Mediterranean trade was sacrificed to political fiction. With its credibility destroyed, the Byzantine economy lost the stability it once had. So what survived? Not verbal promises, nor the written decrees of the empire. Merchants who quietly accumulated pure gold or owned vast lands preserved their wealth. Everyone else watched everything they valued evaporate into thin air. This is the first lesson. Empires cannot resist the urge to multiply their money. And when they do, the value in their hands erodes. While all real value flees to assets they cannot multiply or counterfeit, but not every collapse in history occurs, because rulers interfere with money. Sometimes, entirely unexpected events unfold. In the mid-14th century, a disease known as the Black Death struck Europe. Between 1347 and 1351, nearly half of Europe's population died from the plague. Cities disappeared. Villages emptied. Trade routes ceased to function. The catastrophe that occurred was not only economic, because when half of the physically working population vanished, labor became valuable. Workers were able to demand higher wages. Compared to the number of people, land and food became abundant. Families with the ability to work gained bargaining power they could never have imagined. Land worth fortunes was sold for extremely low prices. If all of this sounds familiar, you're right. In recent history, during the COVID period, logistics systems and supply chains were disrupted. Governments printed excessive amounts of money to keep economies afloat. And inequality increased even further. Those with strength acquired assets. Those living on fixed incomes fell behind. Pandemics, as they always have, contribute to the redistribution of wealth. While the Black Death turned peasants into landowners, COVID made asset holders even stronger. Crises empower those with reserves and eliminate those without them. While pandemics show how quickly economies can reverse, Renaissance Florence teaches us another lesson. Institutions that appear unbreakably, and even the strongest economies can, vanish overnight in the 1340s. Florence was considered Europe's financial center. This was mainly because it hosted powerful banking, families such as the Bardi and the Peruzzi. These families even extended large loans to kings. The worst case was King Edward III of England. When Edward failed to repay his debts, the banks collapsed. Savings vanished. Trade came to a halt. Dark clouds began to loom over once wealthy Florence. The lesson was clear: too big to fail. It's nothing more than a story. Institutions do not exist for people to survive, but for their own profit. When they collapse, they take all savings down with them. This cycle repeats endlessly. Florence. Lehman Brothers in the United States in 2008, Lebanese banks in 2019. This must never be forgotten. All promises remain valid only until the day they cannot be kept. The American Civil War reminds us of another forgotten lesson. During this period, both the Union and the Confederacy learned that a large-scale war could not be fought without printing money. In the North, greenbacks entered circulation. This led to rising inflation. In the South, the situation was even worse. The Confederacy printed gray banknotes in massive quantities. By the end of the war, prices had increased thousands of times over. Salaries became worthless. Families carried bags of money that couldn't even buy bread. By 1865, Confederate currency was not merely weak. It had become nothing more than an ordinary piece of paper. Throughout all these events, what held value was never paper. It was land, food, gold, and everything real. France learned this lesson during the Revolution. The assignats, said to be backed by confiscated land in 1789, were meant to save the economy. But they, too, were printed uncontrollably. Prices rose across the board. Wages lagged behind. Farmers refused money in trade, demanding goods or silver instead. Bread riots erupted. The revolution consumed itself. As always, the winners were not those loyal to the system, but those who were skeptical and prepared. Let's move to 1997. An economic crisis in Thailand affected all of Southeast Asia. Foreign currency debts became impossible to repay overnight. Savings disappeared. Jobs vanished. Those who held dollars or assets abroad continued their lives. Those who trusted local currencies became the losers. Borrowing in someone else's currency is an enormous risk. When disaster strikes, it is not the creditor who disappears first, it is the debtor. These events are not ancient history. Between 2019 and 2021, banks in Lebanon locked their doors. Deposits were frozen entirely. The currency lost nearly more than 90% of its value, regardless of profession. Everyone who trusted the system was wiped out. Money in the bank is not a secure vault. It is a loan you have entrusted to an institution, one that can decide whether or not to repay it. So how do you protect yourself in such a situation? History offers no single answer. In Byzantium, it was gold. After the plague, it was assets. In Florence, it was not trusting banks that appeared powerful. In war, it was holding tangible goods. In Asia, it was avoiding foreign currency debt. In Lebanon, it was getting out before the doors closed. Forms and colors change, but the fundamental principle does not. Collapse is as much an opportunity as it is a tragedy. For the unprepared, it's destruction. For those with real assets and skills, it is the moment when wealth changes hands. The real security is not what you own, but what you can do. In every collapse, money loses meaning, but production never disappears. History does not always repeat itself exactly. But if you fail to learn from it, it will crush and destroy you. The question is not whether something will collapse. It always does. The question is this: will you be left holding promises or reality? If everything I've told you has changed your perspective, subscribe. History always has answers. I'll show you where to look.